Hey everyone, and warmly welcome to a brand new explainer right here on the Gap Advisors Ind AS Clinic YouTube channel. Today, we're setting the stage to debunk a pretty major financial myth. We're going to explore the illusion of risk-free assets and take a really close look at how modern accounting standards essentially force us to see the true financial picture. If you've ever looked at a balance sheet and just assumed certain assets were perfectly safe from credit losses simply because of who owes the money, well, you'll definitely want to stick around for this one.
Okay, let's dive right into this. Here's our roadmap for today. 1. Why standards matter. 2. The safe asset ECL puzzle. 3. The Ind AS framework. 4. The truth about timing. 5. Your Gap Advisors ecosystem. And 6. Final takeaways.
Section 1. Why accounting standards matter. Now, before we really get going, let's quickly lay down our baseline facts for this explainer so both our local and global viewers are grounded in the exact same parameters. For the entities we're looking at today, the functional and presentation currency is the Indian rupee, or INR. Any currency other than that functional currency is classified as a foreign currency. Oh, and our reporting period begins on the 1st of April and ends on the 31st of March. Just keep those parameters in the back of your mind as we move forward. So I get asked this question a lot. Why should any person investing their hard-earned money in the shares of a listed company actually care about accounting standards? Honestly, it's a great question. And the simple answer is that protecting your investment means knowing exactly how a company's financial story is being told and what rules they actually have to follow to tell it. You see, accounting standards act as the lens of reality. Without them, investors risk just looking at the surface-level reported profits, the big bag of money, while completely missing the underlying financial hazards hiding just beneath the surface. These standards literally exist to bridge that gap. All right, let's move to Section 2, the safe asset ECL puzzle. The issue and response we're unpacking today is an incredibly practical one. Let's say a company has invested in or has amounts due from any of the following: fixed-term deposits for 1 to 3 years, treasury bills, group companies' debtors, government companies, and secured debtors or loans. By the way, this specific issue we're exploring was prominently featured in the 216th edition of the Gap Advisors Task Weekly newsletter, authored by CA Manish C. Iyer, director at Gap Advisors, and published over on LinkedIn. Which brings us to our central mystery. As per Ind AS 109, does a company need to provide an expected credit loss, or ECL, allowance on these specific amounts? I mean, common sense might tempt you to say, come on, surely things backed by the government, or safely locked-in term deposits, or secured by loans don't need a loss allowance, right? Well, let's see what the framework actually says. Section 3, the Ind AS framework rules. First off, a quick note for our global viewers. There is absolutely no difference between Ind AS and IFRS for this specific topic, so everything we discuss here applies perfectly to all entities following the IFRS framework as well. Now, what's really fascinating here is just how broadly this ECL rule applies. Under paragraph 5.5.1 of Ind AS 109, an entity must recognize a loss allowance for expected credit losses on financial assets measured at amortized cost or at fair value through other comprehensive income. But it doesn't stop there. It also applies to lease receivables under Ind AS 116 and contract assets under Ind AS 115. So those fixed-term deposits and treasury bills, if they're measured at amortized cost or FVOCI, they are absolutely in scope for an expected credit loss allowance. No exceptions just because they feel safe. Now, what about group companies? You might think intercompany dues get a free pass? Actually, no. Paragraph 7 of Ind AS 8 mandates that when an Ind AS specifically applies to a transaction, that standard determines the policy. And paragraph 9 of Ind AS 27 is super clear. Separate financial statements must be prepared in accordance with all applicable Ind ASs. Unless a standard provides a specific carve-out, these rules apply to common control transactions too. Bottom line, a company absolutely must recognize an ECL allowance on group companies' debtors if they're measured at amortized cost or FVOCI. Which perfectly sets up Section 4, the surprising truth about timing. To really get this, we have to look strictly at how Ind AS 109 defines a cash shortfall in paragraph B5.5.28. You see, expected credit losses are a probability-weighted estimate of credit losses over the expected life of the instrument. And a credit loss, it's the present value of all cash shortfalls. A cash shortfall is just the literal difference between the cash flows strictly due to an entity based on the contract and the cash flows the entity actually expects to receive. So here is the absolute kicker. Because expected credit losses factor in both the amount and the timing of payments, a credit loss arises even if the entity fully expects to be paid 100% of what is owed, but later than when it's contractually due. Think about that for a second. Even if a company fully expects a government company to pay them in full, they still have to recognize an expected credit loss allowance if they expect that payment to arrive later than the contract date. It is all about the time value of money.
Section 5. Your GAAP Advisor's Ecosystem.
Now that we've cracked this puzzle, I want to share where this incredibly detailed guidance comes from. This issue and response is pulled straight from the massive repository over at gapadvisors.com. That site currently hosts over 4,500 issues and their detailed responses on both Indian accounting standards and Indian GAAP. And the best part? Anyone can register for free and submit their own issues for a highly detailed response delivered directly to their registered email inbox. This is an absolute goldmine, particularly for auditors who need to formally document exactly how they addressed a specific issue relating to the application of Ind AS. And remember that Task Weekly newsletter I mentioned earlier? Well, CA Manish C. Iyer has published over 230 editions of it to date. If you're on LinkedIn, I highly recommend you subscribe to the newsletter for free so you can keep getting these technical insights right in your feed every single week. Finally, Section 6. Final takeaways and next steps. First things first, a quick mandatory disclaimer. Please keep in mind that the views expressed in this explainer are the personal views of the author and are not binding on the audience. While this is highly educational, we strongly request that you seek the help of an expert before taking any action or refraining from any action based on what we've discussed today regarding your specific financial statements. Okay, what should you do next? Well, if you need specialized help, you can easily book a one-on-one consultation regarding your issues on Ind AS and IFRS directly with the author through his page on topmate.io. Also, I would absolutely love for you to connect with the GAPI Advisors Ind AS Clinic podcast on Spotify, Amazon, or YouTube for an even deeper dive into the issues we deal with here. Oh, and please share this explainer with your contacts, your colleagues, your audit and finance teams, and especially with students pursuing their CA course. It really helps us spread the knowledge of Indian accounting standards. So I'm going to leave you with this one question to think about. Are your supposedly risk-free assets actually hiding credit losses just because of the timing of their cash flows? It's definitely something every finance professional needs to evaluate. Thank you so much for your time today. If you found this explainer valuable, please hit that like button, add your thoughts in the comments, and subscribe to the GAAP Advisors Ind AS Clinic channel if you aren't already. See you in the next one.